Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by two of my colleagues, my trusted co-host, Cris. Cris, good to see you.
Good to see you, Mark.
Yeah, and we also have Dante, Dante DeAntonio. Dante is a regular on Jobs Friday, and today is Jobs Friday. How you doing, Dante?
I'm well. Thanks for having me.
Yeah, it's good to have you. This is a little later than we normally record the podcast. It is now 5:34 p.m. Eastern time. I've been traveling. I was in New York today, so we're taping this a little early. So I think we're all probably a bit tired, ready for the weekend. Maybe we'll keep this one a little shorter. I know I always promise that. It never ends up that way, but I think you guys will strangle me if we don't keep it to about an hour. So, but a lot of things to talk about today. Jobs Friday. So, any words of wisdom, Cris, before we get rolling here? Anything you wanted to bring up? Not that you have to.
I'm just looking forward to hearing how you're going to say this is exactly according to script and nothing changed, and your odds of recession have actually improved. But let's roll. Let's roll.
You have pinned me. You nailed me. Oh, that's so funny. I am drinking because it is late in the day, my glass of Pinot Noir. So forgive me if I take a break every once in a while and do that. Okay, Dante, let's turn to you first. You want to give us your sense of the report? What did it say?
Sure. I feel like this is probably the same thing we've said several times in the last 6 months, but it was really a report of, I think, mixed messages, right? So I think the top line number.
Can I stop you for 1 second?
Yeah, you can.
Has there ever been a report in your lifetime that doesn't have mixed messages? I'm just asking.
There's been, I would say there's ones that are mostly positive or mostly negative. This one seemed more split down the middle.
Oh, okay. But I don't think there may be in my lifetime a half a dozen.
Now I need to dig one up that's
where everything is in one direction and says this is definitively what's going on. But
yeah.
Okay, well that's why it makes it so interesting. Sorry, sorry for interrupting. Go ahead.
So, the headline number, 263,000 jobs added, was obviously higher than consensus expectations. It's roughly in line with where job gains have been over the last couple of months. We actually saw an upward revision to gains last month, so it was actually higher at 284,000 than it was before. By industry, there was some mix there. There was some weakness in transportation and warehousing, some weakness in retail trade. A lot of that is likely seasonal adjustment issues, a lack of a ramp up in hiring, which we can get into the details a bit later on, I'm sure. But the weakness, again, sort of for the several times now in the last couple of months, is on the household survey side. The unemployment rate held steady, which is good, but the labor force declined. Employment to population ratio declined. Participation rate declined. Employment, as reported by the household survey, declined. So it was pretty much almost a purely negative story from the household survey, even though there was some optimism on the actual job gain side, and sort of that positive as a negative. Wage gains actually ticked up in the month, which obviously is sort of good news for workers in the short term, but probably not good news in terms of potential for a soft landing longer term. I think that's the main story from the report.
Yeah, a lot to unpack there. So in the survey of businesses, the so-called payroll survey, 263,000 jobs were created in the month. And that was a bit above consensus. Consensus was what? A couple hundred K?
About 200,000, yeah.
Yeah, okay. Well, that's within spitting distance for these numbers, right? I don't know. Do you consider that to be a big difference? A meaningful difference?
Not particularly. I think the expectation is continued to be that job gains will moderate more quickly than they have to this point, and these seem to be sort of holding up better than expected month after month.
Which I don't get. I really, if you go back to the beginning of the year, average monthly job growth was double this at least. It was probably, I think it was closer to 600K. So when I say underlying, I mean abstracting from the kind of monthly vagaries of the data. Just take a 3-month moving average of the data, something like that. And we're half of what we were at the start of the year. So it just feels like it's hard to imagine it would be much actually, I'd be a little nervous if it was much faster than that. Maybe suggesting the economy is going to struggle and go into recession. I don't know. It just feels like we are expecting this thing to happen all of a sudden. And it's happening. It feels like it's happening.
Yeah, it just feels like we're increasingly in a world where I don't know how this can continue to happen, where job growth is, 250, 300,000 a month, when labor force growth has been extremely weak in recent months. How do you continue to sustain that level of job growth if
Yeah,
you're
but even there, I mean, if you take that, because that's now that the labor force numbers from the payroll survey. I mean, excuse me, for the household survey, and that's a small survey, and it goes up and down and all around month to month. I don't read much into the month to month movements, but if you look at year over year on that one, we're creating labor force has been growing 250,000 on average per month, and in the last 6 months, pretty solid growth. So it doesn't feel like, yeah, labor employment's strong, it's slowing, but it doesn't feel that much different than labor supply. And that'd be consistent with stable unemployment. The unemployment rate's been stable. I don't think it's changed much. I don't know what, for 6, 9 months. It's probably not changed very much. And the employment to population ratio, which you mentioned for prime age workers, that's no longer rising. If anything, that's declined, right? So that'd be consistent with the idea that you're getting enough labor supply to meet the labor demand. No?
Yeah, I think the problem is just the different story from the two surveys, right? I mean, because in the household survey, you've got labor force declining, but you've also got employment declining. So that's where you get sort of the stable unemployment rate and employment to population ratio that's coming down. But if you try to compare the two surveys against each other, that's where you get these sort of things that don't seem to fit together quite right, I think.
Yeah, and so I think we talked about this in previous months, but the household employment numbers they're softer. They're much softer, right? I think household employment as measured by the survey of households, has effectively gone nowhere since the beginning of the year. Payroll employment, the rate of monthly increase has slowed sharply, as we just discussed, but still pretty solid. 263 still pretty solid. Do you read anything to that? I mean, these surveys will ultimately converge. They're not going to gap out forever. They're measuring the same. They're trying to measure the same thing, and that's employment in the economy, and they will ultimately come back. Do you have a sense of which is leading the way here? Is it the weaker household survey, or is it the stronger payroll survey?
Yeah, in most cases, I would say look at the payroll survey, ignore the household survey, and move on with your day. I think 3 or 4 months ago, I saw the divergence and I said, I'm not really worried about that. Let's wait and see what happens. But now the difference is pretty stark. I mean, you mentioned if you look back over the last 8 months, right? In 4 of those 8 months, household survey employment has declined, right? The total gain in household survey employment over 8 months is 12,000. The total gain, not the average gain.
Oh, is that right? It's like flat as a pancake.
Zero. Yeah. And over those
Yeah.
same 8 months in the payroll survey, you've added just shy of 2.7 million jobs.
Is that adjusting for the payroll concept in the household?
That's not adjusting for if you do adjust for the payroll concept, the gap is, I think, about 1.8 million in terms of jobs that have been created over the last 8 months. Either with adjustment or without adjustment, that gap is the biggest that it's been ever in an 8-month period, aside from the initial impact of the pandemic when measurement
Yeah.
about. Yeah, so
Well,
it's historically large. I agree. It's likely that it'll still start to come back together, but it is getting to the point where it's an unusually large divergence at this point.
right. I mean, one theory I've heard is that when you're in a turning point for the economy, when things are moving up or down, the household survey tends to do a somewhat better job of picking the turn, because it is able to capture what's happening with business failures or starts. And the payroll survey, the survey of establishments, businesses, can't really do that by construction. Right. So if the economy, that would suggest that the economy is slowing and the payroll survey is just not there yet. It can't capture the fact that businesses are failing or scaling back, like the household survey can.
Yeah, I've seen that same argument. I don't want to hang my hat on. I went back and looked at the pre-Great Recession period. So if you look at the 8 months leading up to the official start of the Great Recession in December of 2007, the household survey declined in 4 of the 8 months leading up to December 2007, where the payroll survey essentially didn't decline at all. Job growth in the payroll survey was 3 times as strong as the household survey in those months leading up to the start of the Great Recession.
Yeah. But
Again,
Dante, this time is different.
and I wouldn't hang my hat on that, history repeating itself here, but there is some evidence to show that
Cris
in
is
some
getting
certain points,
so sarcastic over there.
That's right. That's right.
It's the end of the day.
Yeah. And he, hey, go get a glass of wine, buddy. Yeah. Take an edge off. Yeah. Oh, the elbows are already being flung
Ready to
around.
go.
No.
Yeah.
All in good fun.
Okay. All right. Fair enough. So in your synopsis, you didn't bring up like wage growth, or maybe you mentioned
it.
Did he mention wage growth? Did you mention wage growth? Okay, I missed it. Sorry.
It's all right.
Okay. And there, I have one quite more technical question. Of course, this is average hourly earnings. It comes from the payroll survey of businesses, and it can be heavily influenced, certainly month to month, by mix effects. Meaning, if you've got a lot of job losses in lower paying industries or occupations, that could push up the measured wage growth, or conversely, the opposite. Kind of sort of 5% is kind of where it's been since, well, really the beginning of the year. That's kind of been hanging there, and that's high. It's not consistent with the Fed's 2.5% inflation target. Do you get a sense of this, whether this month had anything weird going on with that? Was there mix effects there, or do you think that's a real read on what's going on with wage growth?
I think you could certainly make the argument. You did have some job losses in retail, which is obviously at the lower end of the pay spectrum. So I mean, you could argue that maybe it got a little bit of a boost from mix effects. Although, historically, when the payroll reference week doesn't include the 15th of the month, you get a little bit of a weak read on wage growth. And this was an early reference week, so if anything, you would have thought wage growth would soften a little bit this month, just for sort of timing reasons. But it went the other direction. So I think mix could be part of it, but I do think it's certainly not a positive trend for where we want to see wage growth heading. If you look at the last 3 months on an annualized basis, it's up to, I think, 5.8%. So that's certainly not the direction we want to be headed. That if you look at like the 3-month annualized, that was as soft as 4%, mid-year this year. So it's ticked back up in a pretty meaningful way if you believe the number and don't think it's just purely a mix effect going on.
Yeah, I mean, I didn't have a whole lot of time today. I was in New York meeting with clients, but on the train I did look at kind of average hourly earnings growth by industry quickly and not comprehensively, and I couldn't find any industry where it actually accelerated. The wage growth continues to moderate across most industries. Not every industry. I'm trying to think. Construction, interestingly enough, construction wage growth has remained very strong. But I didn't notice any acceleration. Did you happen to take a look at that?
I did not.
No. Okay. All right. I mean, it gave me the sense that maybe there's some kind of mix effect going on here that might be affecting it. Okay, take a step back. We're in the weeds here, deep into the weeds. Let's just step out, and I'll bring Cris in just a second. In the context of this, the need for the job market to cool, for job growth to slow, for labor market slack to start to develop, the market's been very tight, and for wage growth to moderate sufficiently so that inflation starts to abate. What do you think about this report? How does that fit into that kind of discussion debate? Because that's the bottom line here, right? At the current point in time, how is it? When you look at it from a 30,000 foot level or go down to a 10,000 foot level, how does this feel to you? How did this report feel to you? But let me ask you it this way: I'm a stock investor. I'm a bond investor. You saw what happened. The stock market and the bond market kind of sold off on this, and then came back by the end of the day. By the end of the day, people said, I'm not really sure. Where do you stand? I mean, would you have been selling stocks, thinking that the Fed would be more aggressive as a result of this report or not?
I think it's middle of the road to me. I don't think it moves the needle in either direction. It wasn't overly positive in that, this is great news for the Fed, but it also wasn't, the world is, the sky is falling kind of news either. I think it's a middle of the road. We need to see improvement, but this is just sort of another month along the road to that improvement, I think.
Okay. All right. Very good. All right, Cris, you're up. So, what do you think? Any gaps in Dante's kind of analysis, and what's your perspective?
No, I think he covered it nicely, and certainly that the difference between the household and the payroll surveys is something that is interesting. I mean, it's troubling at perhaps.
Troubling?
Yeah, it gives you some pause. I agree. Household survey is small sample. You don't really want to pay it a lot of attention to it, but the trend is there, right? It's been that gap has been consistent now for a while. So perhaps we are missing something in the payrolls, and the labor market is a bit weaker than what they would suggest. So I worry about a bit of a head fake for the Fed, right? If they're really focusing on that payroll number, right, and not taking into account that it may be misleading, they could make a misstep. I don't think that's going to happen, but next week, 2 weeks from now, but something to consider. The wage.
Can I ask on that before you go on to the wage? So, are you saying that it feels like the labor market might actually be a little softer than the top line payroll employment gain might suggest? The household survey, because of the weaker household survey.
That's what it would. Yeah, if you take it at face value.
And would you view that as a good thing or a bad thing?
So if it's if the Fed believed it, if that was reality, right? The problem is we don't know which one is real, right? If it truly is softening more than what the payroll surveys would suggest, that would give the Fed cover to not be quite as aggressive. Right? The job market's credence. Yeah, it adds credence to the soft landing narrative. Right?
Okay,
there's a chance there.
Okay. Did you see how I got that out of him, Dante? It took a little bit of work, but I got it out of him. Yeah.
Skillful discussion.
All good. But then we go to wages, right?
Okay. Yeah, there you go. Okay, let's go to wages.
And the wages, you're right. Okay, there may be mixed issues here, but so maybe the 0.6% is overstating the case. But okay, you shave it off, 0.5, 0.4, that's still pretty hot. From the Fed's perspective, right? So that would suggest the labor market is quite tight, and the wages are still pushing up. I did take a peek at the Atlanta Fed wage tracker. That's still quite positive. It's not showing. It actually had a little bit of a tick up, and the labor market may continues to be quite strong, which moves in the other direction. Would suggest that the Fed has to be even more aggressive here.
The Atlanta wage tracker. Yeah, I'm sorry. The Atlanta wage tracker, just for the listener, that tracks the same worker through time, and therefore controls for mix effects.
That's right.
The mix effects we were just talking about. And I think the issue there is it's kind of 12-month moving average or something, so you don't pick up near-term movements, so it's hard to get turning points there. But it's still nonetheless,
right?
Yeah, nonetheless. And you're saying that remains strong. The growth in that tracker remains strong.
That's right. Yeah, exactly. We're piecing together. We look at the ECI. It has each of these
employment cost index. Yeah,
correct. And each of these measures has their own issues, but it does suggest that wage growth remains quite strong. Services, right, continue to grow here. Right, some of those wage pressures may be increasing there. So, from that standpoint, I worry about the Fed having to be more aggressive to get inflation down, because the wage inflation is creeping up here.
Yeah. Do you think we're just being impatient, that we expect things to turn too quickly? I mean, it feels like we always do this in economic forecasting, that we know something should happen. Everything is suggesting that it should, and therefore it should happen right now. Instead of this is going to take time, that this all works over a long period of time. I mean, just take the job growth. I mean, at the beginning of the year, all businesses were rip-roaring, hiring as fast as they could, doing everything they could to retain workers. Of course, the Federal Reserve had interest rates at 0. And to turn that ship around, to get HR departments to stop hiring, but then start thinking about, even laying off workers, it takes time, and actually to execute on that takes time, and that for that to show up in the data takes time, and we're just expecting too much too fast in terms of the data flow. That that 263 a payroll employment gain is about as good as you could expect, given the fact that this process only started a few months ago, the switch and businesses from going from hiring to saying, okay, I'm not going to hire, and may even begin to lay off. No? Okay.
Sure. Yeah. These things do take time. Long variable lags, right? We've been talking about the delays in monetary policy all year. I don't know that, and it's right, but I don't know that we have the luxury of time, right? Markets can move, all right? It's the expectations. If the expectation is that things should be moving faster than they are, then in some sense that is reality. That's the reality that the Fed has to cope with, right?
Yeah, I'm not so sure we need to move any fast. All we need to see is inflation moderate. And, my sense is that inflation will moderate in the near term in the next few months, simply as the supply shocks of the pandemic and the Russian invasion fade. Energy prices are now flat. They're actually, I don't know if you've noticed, but gasoline prices have come down quite considerably. And on a year-over-year basis, we're not going to see some real improvements in the inflation statistics because of just flat to down energy prices. And the supply chains are starting, continue to ease despite what's going on in China and the no COVID policy. And it feels like goods prices are starting to moderate, and we may even see some declines in new vehicle prices here pretty soon. Rent growth is rolled over definitively, and that's going to flow into the measures of the cost of housing services and the inflation indices by this time next year. So these are all good things that are going to happen with regard to inflation. Do we really need to see, a moderation in wage growth? And this is key for service price inflation, services X housing and energy, anytime soon. I mean, we're going to see improvements for these other reasons well before. The last thing that's going to happen is the moderation in wage growth and the moderation in service price inflation. These other things are going to happen before that. So maybe we don't need to see it turn that fast.
I don't
You don't see it.
I think if we're not seeing inflation,
wage growth slowing, correct, regardless of all these other things, the Fed's going to be on the warpath.
Yeah. So it's my take.
No. Yeah, it may be the case. May very well be the case. Dante, you did say one thing that factually I wanted to check, unless I heard it wrong. You said the revisions to the previous employment gains were upwards. I think on net they were down.
On net, I said last month was up. 2 months ago was actually.
Okay.
I think 2 months ago downward revision was actually bigger. So yeah, it was down on net. Yeah.
Yeah. So you're impressed how close, careful, how much detail I soak in here. Yeah. So it was a small net downward revision.
Yeah, not a huge impact.
It's got to fit with your narrative, right? That's why
now right. I'm looking at all the data. I am looking at all the data. Okay. Okay. So Cris, same question to you that I asked Dante.
Yeah.
10,000 foot looking down, how do you feel about this report in the context of this desire to see the job growth cool off and the job market to cool off and take some of the pressure off of inflation? Did this report change your thinking around that at all?
Not really.
Not really.
I think in terms of the near term strategy, right, 50 basis point hike from the Fed, I think that's still in play. I don't think this changes that materially, right? If it is moving, in my opinion, here in the wrong direction, but so if we continue to see this very robust labor market in terms of job growth and wage growth, particularly, then that certainly does change the strategy going forward. But I think this one report alone doesn't really move the needle all that much.
So if you're a stock investor, a bond investor, you wouldn't have bought or sold today based on this report?
No, I don't. No,
yeah,
I think it was a little bit.
You don't buy or sell anyway on anything.
Uh-uh.
You're like, I take my paycheck, I take my savings, I put it in the bank, and it goes where it's supposed to go, and I don't even look.
Who says that?
Oh, okay.
Oh,
Oh yeah, that's right. He's the crypto guy.
Oh,
He's day trading on the side, isn't
Day
he?
trading
There
on
you
the
go.
side.
There you
Okay. All right.
farmland. All right.
Okay. Well, I'm in your camp, and that is that I don't think this report today signals anything has changed. The labor market is slowing. It needs to slow more to be
Mhm.
consistent with kind of inflation that we're all comfortable with in the Fed's inflation target. And if I were king for the day and I could control the economy with a few dials, I would have rather seen, instead of 263, probably 163, I think.
Yeah.
Something like that.
Yep.
Fair enough. So I think that's right. But I don't know that based on this, I would jump to the conclusion that the labor market isn't slowing in a consistent way that would be in step with the idea that the economy can avoid it. That the economy can avoid much higher interest rates and to quell inflation and avoid an economic downturn. There were a couple of other statistics that I just throw into the mix that I think are important in this discussion around what this all means for inflation and whether the job market's slowing. One is hours worked. I don't know if you noticed, but the number of hours worked per week fell down to 34.4, and that's now come full circle. That kind of jumped during the pandemic. It's now back down firmly to where it was pre-pandemic. In fact, in the 10 years leading up to the pandemic, it was pretty rock solid, 34.4, 34.5, 34.3, something like this. So we're now back to where we were. And it's come down pretty considerably in the last few months. And that's a leading indicator of job growth, because businesses tend to cut hours of their workers before they actually lay off workers, particularly in manufacturing. And I noticed that I think overtime hours were also down in manufacturing, I believe. I think I got that right. So that's one thing I'd point out. And I think that does augur or suggest that we're going to see much, even slower job growth here dead ahead. Also, I'd point out that we saw, Dante, you did mention we lost jobs in retail, I think in transportation distribution. The other sector that lost was temp help. Temp help is also been pretty, it's not declining a lot, but it's declining. It's been declining now for, I don't know, 3, 4, 5, 6 months. And that's also a leading indicator, right? Because, generally, businesses will cut their temp help work before they actually cut their own staff and the people that they employ. And so that's starting to come in also. Another indication that we're going to see weaker job growth dead ahead. So, from my perspective, you made fun of me, Cris, but I think you're right. You nailed me. It feels pretty close to the script. Yeah, not exactly what I would want if I were king, but it's pretty close to script. It feels like it's pretty close to script. The labor market is moderating, strong, no doubt, but moderating. Here going forward. All the indicators are that it will continue to moderate. Going forward, that we'll get. Well, one thing I do want to say, just because I think it's important that we say it, is we're talking about a weakening job market. We're talking about, things like more layoffs. We're talking about less wage growth. We're talking about, for the person listening to this, they go, what the heck are you talking about? How can that be good?
Oh, no.
It's not, that's not what we're saying. What we're saying is that's not sustainable, because if you have such strong job growth and start wage growth, that means inflation is going to be a problem. That means the Fed is going to jack up interest rates, and that means we got a recession down the road. And nothing's worse for the American worker than going into recession. So we need some slowing here so that we avoid a collapse, in the economy. So that's important to keep in mind. Right now the good news is bad news. The kind of the bad news is good news. So we're kind of in this weird world that we're in right now. Okay. Anything else on the jobs report you want to point out?
Well, I was gonna challenge you on the counterfactual, right? This is going
Yeah.
according to script.
Yeah.
What would have to happen next month to cause you concern, right? If we print another 250K,
He's
is
pinned him
that
down now, so he can't change his mind next month. Is that the
No,
or
250. I
if
mean, I
we're
think underlying job growth is 250K. I mean, I
okay,
think, month to month, I'm not all that worried. Let me put it this way.
okay,
If we get into, say, early next year, February, March, April, and we're still at 250K,
yeah,
that's a problem.
okay,
Okay.
yeah,
If we get into February, March, April next year and we're 150K to 200K,
okay,
I'd say that's okay.
yeah,
I'll tell you what, I think we're all going to get very nervous once things really slow.
yeah,
Once you're below 100 and you're like 50, you're going to say, oh,
yeah,
the whole psychology is going to shift here. And we're going to say, oh, we're going into recession, right?
exactly,
So, we want a slowing, but we don't want it to go, we don't want to go negative, at least not in a consistent way. But anyway, that would no monthly number is going to change my mind to a significant degree. But if we get into next spring and we're still at 250K,
yeah,
I'd say that's a problem, particularly in the context of 5% wage growth, and 3.7% unemployment. If we get there at 250K and labor supply is improved dramatically for whatever
okay,
reason, then
all
I'm
right,
not as worried about it. But
sure,
you know what I'm saying. So but we're getting close to the moment of truth here, on all this. I think we're gonna know who's right or wrong on this stuff pretty soon. All right, let's play the statistics game. And I got a lot of good statistics, guys. I got way too many, but
yeah,
I
a lot.
got a few in my back pocket here. And the game is we each proffer a statistic. The rest of us tries to figure out what that is. The best statistic is one that isn't so easy that we get it quickly, not so hard that we never get it, and it's apropos to the topic at hand. The labor market order came out this past week, and there's a lot of data that came out this past week, a ton of data. So maybe I'll turn to you first, Cris. What's your statistic?
2.3%.
I know exactly what that is. You
I
want
knew
me to
you
tell
would,
you?
but it's a good one.
It's a good one. It's
It's
a
an
good one.
important one.
I'm going to give Dante a chance, and I'm going to whisper to Cris. Okay,
Yeah,
what is it,
yeah.
Dante?
I do not know. I'm going to give you this. Go ahead. I'll
Come
tee it
on,
up for you.
man. You know
Making
the
you look good.
statistics. You got to know the statistics better than me. You're a
I was
young guy.
impressed
Look,
with
you
your
got all that
speed.
hair. Look at the hair on that head. Damn. I
I
have no
spent so much time
hair.
doing my hair, so I
How
wasn't.
can
I didn't
I know
recognize
that statistic and you not know that statistic? That doesn't make any sense. Yeah. All right. Ready? You want me to tell you, put you out of your misery?
Yeah, do it.
All right. It's the personal saving rate.
Yeah, you got it. Oh, I don't have a bell here.
Yeah.
Oh,
All right, hold, wait. Do I got one?
oh,
Where's mine? I
Right off
don't.
the
Why
bell in
my
the
wife
office.
keeps moving things around in this room. This is the not elsewhere classified room. If we don't know where, did I tell you that before? I probably did. If we don't know where to put whatever it is, and we got whatever it is, all kinds of whatever it is, we put it in this room. Yeah. Like I'm
this
looking
is
at
your junk drawer.
Yeah, I'm looking at, dear mom, I hope your Valentine Day was great. This was 20 years ago for my daughter. It's like, okay, but I
Oh,
like
you
looking
can't throw
at it.
that away. You
No,
cannot.
no, are you kidding me?
Oh,
I mean,
no.
there's like zero probability. Yeah, I've got like I don't know what this is all about. I got a disk drive over here. Yeah, who uses disk drive? Yeah, I don't even think I could use a disk drive. Could you? Now, if I gave you a disk drive, could you get anything off that disk drive? Probably not. People out there don't even know what a disk drive is.
That's what I'm thinking.
Trying to remember if I've
Yeah,
ever seen one before.
that's so funny. Anyway, where was I?
2.3%.
Yeah,
savings rate.
2.3%. So why'd you pick that, Cris?
It is very low. It's the second lowest on record. 2005 was a bit lower, and it's just an indication that U.S. consumers, yes, they are continuing to spend, but they are having to use more of their income. They are dipping into their savings. They are going into credit to finance that spending that they are doing. So something certainly to watch. 2.3. It isn't sustainable over the long run, certainly, but
Okay,
it does indicate some of the weakness out there.
Dante. I'm going to test Cris. This is a
Yeah.
test.
Oh boy.
Okay, Cris, what month historically had a lower saving rate than 2.3%. Dante, look, I see Dante's face. He's incredibly impressed
So it
by
was 2005, April, I believe.
Oh, that's good. I thought it was July.
Oh,
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 Dante,
how do we
can you
confirm
check that? Can you
it?
check that?
I'm gonna say Mark's right and just go with it.
Yeah, just go with it.
Oh.
Just go with it. Yeah. Okay, I'm duly impressed though. That's very good. Yeah. Okay, so but Cris,
Yeah.
uh, how do you view? I mean, on face value, you'd say, "Oh, that's a problem." 2.3% low saving rate. Do you view it as a problem?
Not at the moment, because
Yeah.
that is the saving rate, right? That's how much of income is being set aside going into savings. People have a lot of wealth, a lot of savings still in their back pocket that they're using to support their spending. So excess savings, by our calculations, is 1.8 trillion, right? So it's not as though consumers are totally tapped out here. Some of them are, but in terms of the big picture, right, it's just an indication that higher prices are stretching those monthly budgets. But so something to watch. If it continues for a long time, it gets more troublesome, because those savings that they do have squirreled away, the wealth they have squirreled away, does start to run out. But
Yeah,
not,
I mean,
not an immediate red flag.
Yeah, I mean, it goes to the excess saving, all that saving built up during the pandemic, right? I think.
Mm-hmm.
And, by our estimate, the excess saving peaked in September of 2021 at $2.5 trillion. That's 10% of GDP. That's a boatload of excess saving. And as of October, it's down to 1.8 trillion. So we went from 2.5 to 1.8. There's a $700 billion decline. That if the consumers spend that excess saving, it's saving sitting in their checking accounts, that reduces the measured saving rate, because the measured saving rate is the difference between current income and current spending. So this is they can spend more because of they just drew down this asset, their checking account.
Right.
But it's still 1.8 trillion. It's still a lot of cash. Now,
Yeah.
I agree with you. For that cash, that excess saving, that 1.8 trillion is sitting in the bank accounts of high income, middle income households, not in the checking accounts of low income households. Probably the bottom third at this point, I would say, probably blown through the cash. But for the aggregate economy, painting with a broad brush, abstracting from the differences across income groups, that's where the bulk of the spending occurs. So it would suggest that consumers still have firepower here, and they can continue to spend in the face of pretty high inflation, at least for a considerable period. Would you agree with that?
Yeah, certainly at the macro level.
At the macro level,
particularly those middle and high income.
Yeah.
I do worry, though, that those lower income households are going along with really based on credit. When those bills start to come due after the holidays and the first quarter, if we get that type of slowdown in employment, if inflation is not moderating fast enough, you will see delinquency and default rates creeping up here on credit cards and personal loans, right? So
yeah,
you're
totally,
right.
totally.
In the macro view, maybe that's still not quite an event, but we're definitely going to be feeling it as a broader economy. This is, whether we go into recession or not formally, you're definitely going to see some financial pain out there.
Yeah, that's very much the case, and in no way do I want to suggest that this isn't very painful, particularly for the high inflation and particularly for low income households. They're getting crushed by this financially. Right. But from a broad macroeconomic perspective, staying out of consumers in the game, spending in aggregate sufficient to keep us out of recession, feels like there's still a fair amount of firepower, financial firepower out there to allow them to keep on spending. And even for the low income households, in terms of the credit problems that you described, it doesn't. The numbers aren't big, right? I mean,
no, it's still
like if you look at credit card receivables or unsecured personal loans, they're up what, a couple $100 billion from where they were pre-pandemic, something like that.
Yeah, not again, not we're not at crisis levels here. It's not a red flag event, but definitely there are some sectors that are or some segments of the population that are under stress and are going to continue to feel stress for a while here. So
Yeah. All right, Dante, what's your statistic of the week?
It is 48.4.
oh, is that an
48.
ISM?
Cris, he's really diving right in there.
Yeah.
Yeah. Was it the ISM
No, that was
manufacturing?
49, wasn't
I
it?
thought it was 49 for, but maybe this is one of the components of the ISM.
Yeah.
And I'd say it's the employment
Employment. Yeah.
component of the
You know
ISM.
me too well.
Yeah. Okay, that's a pretty good one. Yeah, very good. You want to explain?
Yeah, so you had brought up, some potential future weakness in manufacturing employment maybe down the road with hours starting to come in. The employment component for the ISM manufacturing index has been below 55 out of the last 7 months. And historically, on a month-to-month basis, it's pretty volatile compared to employment. But historically, if you get, sort of a consistent reading below 50, that's typically consistent with manufacturing employment that's either flat or even declining. So it would certainly be sending a red flag that manufacturing employment could roll over here at some point in the next few months and actually start to show some declines. It's been moderating like the rest of the job market, but it's held up pretty well up until this point.
I've been a little surprised we haven't seen more job loss in manufacturing. Given the tech layoffs, I guess those though might not show up in manufacturing. They might show in trade. Oh, maybe we're seeing it in the Amazon layoffs and the trade in the transportation and distribution. But I would have thought some tech would have shown up by now, but no, not in that. Here's the other thing I worry about, or wonder about, or worry about in the context of we need to see a slowing in the job market to cool off inflation, wage and price pressures. Could it be the case that we don't see the kind of job losses we typically do in manufacturing and construction? These are rate sensitive sectors of the economy for idiosyncratic pandemic related reasons. So, for example, in manufacturing, the vehicle industry has been very depressed because of supply chain issues. Now the supply chain issues are moderating, we're getting more production. And we might need to see the layoffs in the vehicle and vehicle related industries that we typically do. And therefore we don't get the manufacturing layoffs broadly that, would help cool off the labor market. And in the construction trades, I think we are starting to see job losses on the residential construction, on the single family residential construction side. But maybe we were not going to see the kind of layoffs we typically do. And that is the most rate sensitive sector of the economy because workers are going to go over and work on multifamily projects because there's such demand for rental property. And now we've got the infrastructure bill legislation kicking into gear. That was a piece of legislation that bipartisan infrastructure legislation that was passed back. When was that? That was probably about a year ago now, wasn't it? And I think that money is starting to get out. It's going to really kick into high gear in 23 going into 24. And these are things that are idiosyncratic to the period, this current environment, and we don't see those job losses that we typically do in those rate sensitive sectors, and that becomes actually that's good news is bad news, right? Again, I'm not saying I want to see layoffs, but we got to see layoffs somewhere if the job market is going to cool off to a meaningful degree. Does that resonate what I just said, Dante, Cris? Anybody want to respond to that?
Yeah, I would agree.
Go ahead.
I think there's some reason to think that they hold up better than they have in past cycles. I do think you'll still see employment declines at some point, but they may not decline nearly as strongly as they have in previous cycles.
Yeah. Okay. Cris, did you want to say
what are your thoughts on the reshoring? If we're building chip factories and with battery factories and whatnot.
Yeah. I mean, if you look at manufacturing construction put in place, so this is actual construction of manufacturing facilities,
right?
It's booming, and it's taken off, and it's got to be in part related to the bringing back of supply chains, the reshoring, as you said, for reasons of resilience. I mean, companies are very nervous about these long supply chains in the context of the pandemic and all the conflicts with China that are in train here. So yeah, I think that's true. That's a good point. Something to watch. Okay, that was a good one. was going to say one other thing. I can't remember. So, ISM non-manufacturing that comes out next week, right? Yeah. Okay. So we'll see what that shows. Okay. You want me to give you my statistic?
Lay it on us.
All right. You ready? You ready?
Ready.
6 million. It's a really good one.
Is it JOLTS number?
JOLTS. Job opening labor turnover survey report. 6 million. Dante, you should know this one too.
Hires.
Okay, baby. He's coming on. He's finally coming on.
That was a few days ago. I got to really
dig very good.
So much stuff just yesterday that
I thought I had you. I got another. I'm going to do another one though, related in a minute. But 6 million is the number of hires in the month. In the month of, I guess it was the month of October, because it's 1 month lag compared to the jobs report we got today, which is for November. And that's exactly equal to the number of hires when this is a good test.
Right before the pandemic.
Exactly. February of 2020. On the nose. So the number of hires has come full circle. It peaked at 6.8 million back in February of this year, and they've come back down to about 6 million. And so, hires have normalized. And I think that's consistent with the idea that the labor market is moderate, is normalizing. It's starting to cool off. Okay, here's the other one. 1.4 million
layoffs.
Very good. Yeah, very good. You knew I was going to say that. 1.4. Here's the issue. What was it before the pandemic? Pre-pandemic. So there was 1.4 million layoffs in the month of October. What was it in the months leading up to the pandemic in late 2019, early 2020?
Still a little bit higher than that, I assume.
Yeah.
I don't know.
1.5, 1.6?
No, 1.9.
Oh, wow.
1.9. In fact, in February of 2020, if I've got it in my mind's eye, so I might not have it exactly right. I think it had 2 million in February of 2020. Yeah. So that's the difference. That's the key difference between this labor market and the labor market, pre-pandemic, which was pretty tight. And it goes to, we probably, if we're going to get a cooling off in the labor market sufficient to forestall more aggressive Fed hikes and ultimately a recession, we need to see a normalization in layoffs. That we're still not quite there yet. Got a ways to go. I thought that was pretty interesting. I will say the JOLTS report, the job opening labor turnover survey report, all of the measures in there kind of sort of suggested the labor market is moderating, though. Hires were down, layoffs were up a little bit, quits were down. The number of people quitting their jobs is moderating, and the number of unfilled open positions still very high, but coming in. So everything is moving in the right direction. Sticking, as I would say, to script. Sticking to script. Sticking to script. A script. Maybe not the script, but a script. A script. Okay, so Cris, what do you think this all means for monetary policies? And so, just to level set and the probability of recession. So here we are getting close to the end of the podcast. I do want to go back and see if your odds of recession have changed, or what you're thinking about this, about any of this has changed. But just to level set, in our current forecast, we have the Federal Reserve raising the funds rate another 0.5 point when they meet. I guess it's next week. 1/4 point in January when they meet. 1/4 point in March, and that raises the federal funds rate target, the interest rate they control, from just under 4% currently to just under 5% by, I think it's March or April of next year. And then they keep interest rates stable until we go into 2024, and at that point, inflation normalizes, and oh geez, there goes my wine glass. Sorry, it's not an expensive wine glass, so no worries. And I had already drunk my wine, so no big deal. No big deal.
No dry cleaning.
No dry cleaning. Yeah, don't tell my wife. So that's the path. We go back to the equilibrium funds rate in 24 and 25.
So you got another hike in there in March. That's
yeah, we put that
new.
in. Sorry, I should have said that. Yeah, we did put that in. Did we have that last month? I don't know that we did. Yeah.
No,
so we'll put one more in.
So you're a little concerned the inflation doesn't moderate fast enough here?
Well, it's more that that's market expectations, and that's what's embedded in. I think that's market expectations, right?
Yeah.
That's what investors are pretty close to what investors are thinking. So that's what's embedded in stock prices and mortgage rates, the value of dollar, that kind of thing. So just, I think that just to be consistent with market expectations, and I think that's reasonable. So we incorporated that, but and so how do you? Does that sound like a reasonable forecast at this point? Or are you expecting even more rate increases? Would you expect more rate increases?
No, I expect that's the case.
Yeah.
Also because I expect that after that comes the recession, right? So they won't get a chance to hike further, or what they won't need to hike further.
Do you think they'll get to 5% or not even get there?
The 4 3/4 to 5. I think they'll get there.
They'll get there.
That'll be the last straw, if you will.
Yeah. Actually, your forecast is pretty consistent with market expectations, isn't it? I think the market investors, if you look at futures for Fed funds, they have the interest rates coming back in the second half of 23, particularly in the first half of 24. I don't know if they're discounting recession, but they are actually,
they
aren't they?
Are, right?
They definitely are.
Minus 80 basis points, Mark.
On the 2-year, 10-year spread.
And the 10-3.
And the 10-3. So investors, by that inversion with short rates rising above long rates and the expectation that they're going to be cutting in the second half of next year, first half of 24, would be consistent with the idea that bond investors think a recession is coming.
Right.
Yeah. Okay. So what is the probability of recession in your mind at this point?
I'm going to stick with 70. I'm tempted to go to 75, but I want to see a little bit more data.
And because why are you tempted to go to 75?
The wage data here makes me, and the labor market data we talked about earlier, and the perhaps mixed signals, right? That may lead to a Fed policy error.
I see. Okay, but you're sticking to 70 right now.
Yeah.
Okay.
I'm giving you benefit of the doubt there.
Okay. All right. So it's so interesting. Dante, I can't recall. What was your last? Were you on a month ago for the last jobs number?
2 months ago, yeah.
2 months ago. So what was your probability of recession 2 months ago?
I think it was 50. It's either 50 or 55.
Okay. And what is it now?
I would say it's 50 now. I would say it's probably unchanged from 2 months ago. My mood hasn't really changed since then.
Oh, but it sounded like you might, if anything, you've become a little more optimistic. No, on the margin.
I'm neutral. Yeah, I mean, maybe slightly more optimistic on the margin.
So but you said 50. You're at 50%.
Yeah.
Did you hear that, Chris?
Yeah.
Does that surprise you?
It does. It really does.
Mark has brainwashed me.
He's gone to the dark side from your
I was the dark side. No?
You are the dark side, but I'm your dark side. You're my dark side, and I'm your dark side. And Dante's definitely gone to the dark side. I'm not sure which dark side he's gone.
Is there a light side? Is there a good side?
No, it's all dark.
It's all dark.
It's all dark. It's all dark. That is interesting.
50. You're sticking with 50.
Okay, Dante. You know how when people do a forecast, like a GDP forecast for calendar year 2023, and then sometimes they show an up arrow and a down arrow, meaning the risks to my forecast is up or down. So take your 50%. Is your arrow up or is your arrow down? Chris's arrow is down. No, it's up.
No, up.
It's up. Sorry,
definitely up.
Definitely up. Yeah, on the probability of recession? Is your arrow up or down?
I would say I'm at 50, but my arrow is up. I think there's a bigger chance that I raise those odds in the next 3 months than it is that I bring them down.
Okay, interesting. Okay, so I'm at 50% probability of recession, and we're talking about recession it's through the end of 2023.
Yeah.
The recession will start. An NBER, National Bureau of Economic Research, defined recession will start between now and the end of 2023. I'm still at 50%. I haven't changed, but my arrow is down. My arrow is down. I'm feeling better about this. Yeah, I really am.
Oh,
did you see the inflation statistics this week? The
Pinot Noir does that,
Huh?
Pinot Noir. Yeah.
That's the Pinot Noir?
Yeah, a little glass of wine.
It's the Pinot Noir talking. Yeah, maybe you're right. I probably should have had a whiskey. Then it would. Then it would have gone down to 45%. Yeah.
And the gin and tonic.
Yeah, I'm off gin and tonic. I can't
Oh.
drink any more gin and tonics. Done. I'm done with that. Okay. All right. Well, I think we know where we stand. And as I said, I think we're getting closer and closer to the moment of truth here. I think we'll figure this out. Any other thing we want to talk about before we call it a podcast? I promised that we were going to keep this to about an hour. I think we're pretty close to time. Any other issues you want to bring up? Dante, anything we missed?
No, I would just say you said we need to be patient with the job market. I think I would prefer to see some actual moderation here a little bit more quickly in the next couple months to make me happy. So
It's moderating. What are you talking about? You're saying faster moderation.
fast. The last 4 months, 292, 269, 284, 263. That doesn't feel like a whole lot of moderation in the last 4 months. That just feels like we're stuck there at 270 or whatever that average is. That just feels like we haven't
He's got
gone
a point. He's got a point.
He's young. He's impatient.
And the month before that was 537. That's certainly not, that was a not a
What
good.
was it at the beginning of the year, my friend?
Well, January was 504.
There you go.
July
Okay.
was 537 again. So
There you go. Oh, okay. Okay. I think I want to start. We've tried this in the past. Let's try it again. I'd like to solicit to our listeners, if you have questions that you'd like us to answer, something that's really bugging you about the economy, obviously, fire away and send us an email. We're all both on Twitter. Are you on Twitter, Dante? Can't remember. No? Okay. I guess fewer people are on Twitter these days, but if you're still on Twitter, send a DM, and ask a question, and we will address that on the air on our podcast. And I think other listeners would value it. So if you've got a question you would like to ask, please fire away, and we'll take it up in future podcasts. Okay, with that, we're going to call it a wrap. Thanks, everyone. Take care now.